Welcome to episode 4 of the Cash Flow Connections podcast. The topic for today's podcast is how to find lucrative investments in today's economic climate. There's always going to be a debate as to where we are in the economic cycle, but our guest today is going to present a solid case that we're coming to the tail end of the cycle based on some very undisputable data points, and I tend to agree with him wholeheartedly. In fact, our guest believes that a price correction of 20% or more is very likely in the multifamily space over the next few years. In fact, he's actually looking forward to it. So the question becomes, how can we continue to invest profitably in this stage of the economic cycle? So we're going to discuss some of the data points to look at when considering where we are in the cycle, what type of opportunities to pursue during this stage, and how to structure deals to protect us against this upcoming price correction. So if you're interested in any of these topics, you're going to enjoy this episode. So let's get right to the interview. How's it going, everyone? Today, our guest is Jason Post, who is the founder and president of Post Investment Group, which is an opportunistic real estate investment company focused predominantly on the acquisition and development of apartment communities nationwide. The company's footprint currently reaches 10 states and over 15 cities, with a heavy focus on California, Texas, New Mexico, and the Pacific Northwest. Jason has directed well in excess of 100 real estate transactions totaling more than $1.5 billion in capitalized value. He's taken over 60 deals full cycle and has acquired and operated approximately 25,000 apartment units. So a massive portfolio, a massive track record. Jason, tell us a little bit about your background overall and how you got interested in multifamily.
Sure. So I didn't come from a real estate background. I was 27 years old in 2002, was doing I had several different ventures in entrepreneurial business and scraped together some money with a couple of other guys to buy an 8-unit apartment building in North Hollywood, California. Really didn't know what I was doing, got very lucky, both in terms of timing, even though that the thesis was built around the fundamentals of the market at the time. But got very lucky in terms of the building that we selected to buy and the underlying investment thesis, but basically started with an 8-unit building in North Hollywood and then bought a 6-unit building in what was called Filipino Town in Los Angeles, and then a 33-unit brick building in Koreatown, MacArthur Park area. And then between 2002 and 2005, I assembled a portfolio of, give or take, 1,000 apartment units in approximately 30 buildings. Typically, the picture was 1920s construction, brickers, rent control projects, and then we also did a variety of non-rent control projects in the San Fernando Valley. Sold that portfolio between 2005, 6, and 7, and then started diversifying into the Texas market. Founded Post Investment Group in 2007. We're a 10-year-old company coming into this March. And over the years, we've acquired, owned, and operated about 25,000 apartment units.
Wow, that's incredible. So, part of the topic for today is about, kind of looking at economics and pinpointing where we are in the cycle, where it's a good time to buy and sell. How did you identify that time to sell in 5, 6, and 7 in California? What were some of the things that you really saw that made it clear that you needed to divest out of California and start looking at Texas?
Well, a lot of the similar fundamentals as you're seeing now, which are high occupancies, high rental rates, low cap rates, low interest rates. So very similar to where we are in the cycle today. I was also in an inferior product class, or at least what I deemed to be an inferior product class in California at the time. So wanted to elevate the business profile. We had sold in those years in California, and then really started looking. When we founded Post, it was built on taking advantage of distressed investment opportunities. So really I think it was the third deal we bought at Post, which was really our first distressed deal of the cycle, was bought in July of 2008, kind of simultaneous to the beginning of the markets falling apart. And we bought a 30% occupied apartment community in Amarillo, Texas, which we still own to this date. And, the rest was history. But the real reason we migrated from California at the time to Texas was we followed the population and the job demographics. It still happens to this day. People are migrating from California to markets like Texas, where there's no state income tax, You have large employment growth, albeit Texas does have some risk factors that California doesn't, such as ample land, inexpensive construction. They build a lot more in Texas than they do in California. Albeit in this cycle, California, LA specifically, has been building quite a bit of new product.
Interesting. So from a big picture standpoint, you touched on a little bit earlier, where do you see us being currently in terms of the market cycle in terms of multifamily?
I think it's very late. Again, fundamentals perfect. It's a perfect storm. Historically high occupancies, historically high rental rates, historically low cap rates, historically low interest rates. You've got a historically high development pipeline coming through to fruition. We're kind of in line with the 1980s in terms of construction pipeline. So really, in my opinion, we're very late in the cycle. I've been saying that for quite a bit of time, so I've been wrong. Obviously, the Donald Trump effect, where maybe gives us a couple more years in this cycle, but definitely late. I don't know how steep the downturn will be this time around. I don't know what economic event is going to cause the market to collapse, but we're definitely bracing for some level of correction or softening. We're actually even seeing softening right now, both in rents, occupancies, concessions, and also prices, cap rates, and prices. We're seeing it in select markets around the country.
Okay, so just give us a little bit more locality then in terms of, are you guys currently invested in California at all, or is this almost exclusively in Texas at this point?
So we diversified from California, where we really shifted from California to Texas between 2008, 9, 10. But since then, we've expanded our footprint to 10 states, 15 plus cities. So we are, our highest level of concentration is Texas, and California, with additional concentrations in New Mexico, Colorado, Oklahoma, Arkansas, Louisiana, and the Pacific Northwest. So we like to say we're Texas to the west. But we do have a heavy concentration up and down the coast in California. Really nothing in the city of Los Angeles. We have some assets in the county of Los Angeles, but we are up and down the coast in California.
Wow. Okay. And you're seeing substantial softening in most of those markets in terms of rents and price and concessions?
No, definitely not the emphasis, not on substantial, but we are seeing it. And that sentiment is being echoed in other markets around the country, like Miami and New York. And certainly markets like Houston, which we're no longer in. We were very long in Houston. Houston's a funny market. We'll talk about it later, but it's the only market I've ever actually really lost money in real estate. So, but you're definitely seeing softening in select markets. For typically at the moment, it's overbuilding. In markets like Houston, we actually bought a deal in April of 2016 in Midland, Texas. And that deal was soft as a result of the downturn in oil pricing and the glut of oil. So that was a situation where you have very select distressed pocket in the country. And our thesis now is that you'll see that echoed, or you're seeing that echoed in Houston, where anecdotally we were at National Multi-Housing Council meeting last week in San Diego, and as we were talking with brokers in Houston, their anecdotal data point is, well, you could buy in Houston today to 5 cap, but it was last year's 7 cap. The point being is that they've seen the softening as a result of all of this new product coming online and the job growth not there to support the new product.
Interesting. Okay, cool. So that's really, the telltale sign of it coming to a close in terms of the market cycle. That last piece is the development piece, because it becomes profitable enough to get in there and take those risks to build. So when people start to do it and the square footage all come online at the same place, then you have real pressure on prices, both in terms of rents and in terms of cap rates. So that makes sense. So given that we are starting to see this massive development in a lot of the markets you're looking in, what do you think the odds are that there's going to be a significant, let's say 20% correction in multifamily during the next 4 years or so?
Well, I hope there is one. Let's start with that. That creates the buying opportunity. I think a 20% correction in prices, I don't think that's a steep correction. I think that we should expect to see something of that nature. I think the likelihood of that, it's there. It's definitely there. But being a capitalist and, I don't know what will happen under the new presidential regime, and I don't know what new life the current administration will breathe into the market. I do think if they do breathe new life into the market, that it's going to compound the bubble, which will just make the landing that much harder, which will create that much more of a buying opportunity in the next cycle. So I think the chances of a 20% correction within the next 4 years are high. I think, though, the longer it gets pushed out, the harder the fall is going to be, which will create the bigger opportunity for those who are patient. Patience is a killer, though. It's very hard to be patient in this business.
Makes sense. So I know it's kind of speculative, but I have to ask, what do you see as being some of the catalysts then for this 20% price correction?
It's always black swans. I mean, again, I don't know that a 20% price correction is that dramatic given the run up we've had. And let me illustrate on the magnitude of the run up. I was anecdotally, talking with friends at the NMHC conference, and we were laughing over how in November 2009, I had bought some properties from some REO sellers and special servicers for $15,000, 15 per unit in Austin, Texas. We renovated them, so that's not a true. My basis was called 25, 30,000 a unit. We had sold those buildings there were several of them, between 55,000 and 75,000 a unit. Then they sold again to the tune of 75 plus, and now they're trading again for over $105,000 a unit. My point is that we've seen massive run up in prices in markets. So a 20% correction, in my opinion, wouldn't be that dramatic. What would happen to cause something like that? There's always something lurking. There's always a black swan somewhere out there. Could it be an interest rate rise? Well, we had that. We had that after the election. Interest rates, treasuries, the stock market went up. People got out of treasuries, and the 10 years up. Interest rates are higher. That's caused some softening. New development is causing people to have concessions and drops in occupancy. And then you've got investor sentiment. If once investors start to cool their, to expect things to get worse, they'll start paying lower. They'll start, there'll be less competition for bidding. Cap rates will soften. So I think a 20% correction would be a minor correction, not creating a tremendous buying opportunity. It should be expected, and it's going to be a variety of factors. And then we haven't talked about jobs and things like that, but I don't think jobs is going to be the issue in this environment. And then who knows what's going to happen with the administration? Do we have mass migration out of the United States, which is going to create more softening in certain markets? We just don't know. That's where the black swan theory comes into effect. It's going to be something, we don't know what it is, but it's likely going to be a combination of just logical items like we talked about.
Got it. So the interest rates, that's something that's always on everyone's radar. I definitely want to get your perspective on this, because interest rates, though they are somewhat centrally planned, they're supposed to be a function of essentially supply and demand, right? So timing your buy based on interest rates alone does not make a lot of sense. But how do you anticipate the rise in interest rates dictating cap rates? Or do you see that being a really strong correlation, or something that you're definitely keeping an eye on?
Yeah, I mean, they definitely should be correlated. They could invert, right? Interest rates do rise. If they rise to a point, there'll be some level of inversion where the spread, typically cap rates are higher than interest rates, but they could invert to where interest rates are higher than cap rates if interest rates went up to unreasonably high levels, without defining what those are. Being said, they should also, within a band, and we're in that band right now, they should work lockstep and barrel. So in theory, a basis point increase in interest rates should, in theory, result in a basis point increase in cap rates. It doesn't work perfectly like that, but we definitely saw real estate deals are priced to perfection. So as a result of that, any softening, so a rise in interest rates, should definitely have an impact on pricing, and we are seeing that. A drop in occupancy, or a drop in projected rent growth, or just a drop in rent prices, not even growth, those all should play into account with cap rates. So the answer is yes, cap rates are moving up, in my opinion.
Got it. And so, when you mentioned the inversion there, just for the listeners, what that essentially would mean is that people will be borrowing money at a more expensive rate than the cap rate, meaning that they would actually be paying to purchase real estate. Now, some people may say, there's a lot of value add in this situation, which makes the cap rate increase as you're increasing the NOI. But that's when you're really getting to the speculative end of the market cycle. If people are willing to take on those risks in exchange for later appreciation down the road or speculative NOI increases, that's definitely something that would be a big red flag.
Let me just add one thing there, Hunter. I kind of, part of me can't wait for that to happen, and that's what happened in like the 1980s, I'm not, and I was in school in the 1980s, so it's hard for me to really point my finger at it. But I know there were times where you had very high interest rates, so it was very speculative. People were, in that environment, you would want to be taking on very little leverage, being very careful with your leverage. But real estate values, in theory, should be lower. Interest rates should be higher. So there'll be some, you have the opportunity for cap rate compression at that level. So if you're borrowing at 8 or 9%, I'm talking about a situation where you're really borrowing at rates that are astronomical, which we probably will never see again because we can't afford to as a federal government, or no government, no nation can afford this. But if interest rates are 8%, I wouldn't expect to buy a 9 cap real estate deal. But if interest rates are 8%, maybe you can buy a Class A building at a 7% cap rate, knowing that, or thesis being that interest rates will ultimately come back down to 5%. You'll see cap rate compression. That's where you really get crush your return, is when you have that compression. It's a thesis. It's something that's happened years in the past. I don't expect it to happen anytime soon, but part of a thesis that you can have for the future.
Interesting. I'm glad that you added that extra point in there. It's very interesting. So given that we are in this situation in terms of where the economics are pointing us, what type of investments are you pursuing, given your knowledge about this topic?
Yeah, so we're very opportunistic. So we really like to acquire assets. Our strategies are predicated upon where we are in the cycle. So 2008, 9, 10, 11, distressed. Now there's no distress. We bought one deal in Midland, Texas, that was the only distressed deal we've been able to buy at the cycle, which was truly a unique situation given where the price of oil collapsing. Midland's completely dependent on oil. So that's not a scalable strategy. The strategy we employ at this inflection point of the cycle tends to be around low-income housing tax credit projects. And the reason why is because we're buying properties that are income restricted, meaning the tenants can only make X percent of the area median income, and their rents, we're limited to how much we can charge in rents. So you would ask, why would you do that? Well, you have a lot of insulation. So number one, you're buying cap rates. Typically, your cap rates are higher than that of their market competitor, even though their market counterpart properties, even though you've seen a lot of compression in that world as well, where tax credit projects are trading for very close cap rates to that of conventional deals. But in a tax credit project, your tax credits may burn off in 10 years, 12 years, 15 years. And there's a huge disparity between in-place rents for the tax credit project and market rents. If you have a 30 or 40% disparity in rents, number one, you're going to realize and recapture that when the project reverts to market, albeit down in the future. But you also have insulation. So if the market softens, or when the market softens and occupancies soften and rental rates soften for market rate properties, there's a long way to go before your tenants would be, you would have to drop your rental rates and your occupancy would drop. It's a thesis we have as well. We've been employing this strategy since about 2011. We've done very well with it, but we've also done very well with it because when we bought these projects, the rents were below max tax credit. Now we've taken them to max tax credit, and now we're kind of holding on where they're literally full occupancy, full rents, and way below that of their market counterpart. So we'll see how this strategy now works as we buy these new deals that are at max tax credit.
Got it. And what rental rates are we talking about here? What's the range of the type of properties that you guys have? What are the monthly rental rates for these units?
Oh, it really runs the gamut. The affordable world's so complicated, which is another reason why we love it. Your rents are dictated by HUD based on formulas set forth. So we have projects, the typical project, the tenant has to make no more than 60% of area median income, and the rental rates, they still could be healthy for 1990s vintage construction and call it Bremerton, Washington, which is a Seattle MSA. We're looking at a project up there where the rents, I believe, for the deal are $1.28 is the maximum tax we can charge. The market rents are now $1.48. The market occupancy, everything is in the high 90% occupancy, plus the market rents. Market rate deals charge RUBS. We can't charge RUBS in these tax credit deals, so there's even more insulation there. So to illustrate a specific example of a deal, you got Bremerton, Washington, blue-collar suburb of Seattle, where market's at about $1.50 and in place for our projects at about $1.30, rounding up.
Got it. All right. So you mentioned Seattle, you mentioned Midland. What other markets are you looking at?
We have a wide net. We're always looking for new markets that aren't too far outside of the footprint of our existing footprint. We tend to not go east ever. We've recently acquired a project in Oakland, or it's Richmond, California, which is a suburb of Oakland. That's another affordable project. We recently recapped a project in Dallas, Texas, where we own quite a few deals in Dallas. We recapped existing investors out of that project. We have a wide net. We're in over 15 cities in 10 states.
Awesome. So the diversification there, as well as the mix of the affordable component with the discrepancy in the market rents, definitely the strategy that you're using, and it sounds like it's going really well, which is awesome. So from a deal structure perspective, what are you kind of implementing there to protect your investors as well as yourself?
Yeah. So the key here is leverage at this point of the cycle. I've never been fearful to use high leverage on deals, and we'll get into again later the deal. I'd like to illustrate a deal I lost money on and how high leverage actually hurt me. But I've never been fearful of using high leverage in the past. At this point in the cycle, our very strong bias is towards using very low leverage. So, for example, the deal in Bremerton, Washington, we are looking at using 65% leverage, which some people may argue that that's still high, but we think it's pretty low compared to where we're buying it cap rate wise and where interest rates are. Plus, when we do 65% leverage deals with Fannie Mae or Freddie Mac, they tend to give between 5 to 7 years of interest only financing. Plus, you get pricing credit break. You get breaks on your interest rate pricing for two reasons. Number one, for it being lower leverage, but number two, the agencies, Fannie and Freddie, love affordable housing. It meets a mandate that they have with the FHA. So we are able to get price breaks. So that's how we're mitigating downside, is through low leverage. We get interest only for a long period of time, low interest rates, and the debts as a result, the debt service coverage ratios are well into 2x, and giving us a huge downside protection for unforeseen events.
I'm really glad that you said that, because I actually, this is going to be funny. I actually just wrote an article about interest only portions of loans. And I was saying, if they're taking aggressive leverage and they're using 5+ years of interest only, that's a big red flag. However, later in the article, I kind of go through some of the other loan terms that are important. And the fact that you are looking at the whole picture, it is clear that you're very concerned with taking too much leverage. So if you're looking at a 65% loan to value ratio and you're using 5 years interest only, but the debt service coverage ratio is 2x plus, from a big picture perspective, you're taking all those things into consideration, it becomes clear that you're being very conservative in your loans. But still, that 5-year interest only portion seems a little bit extensive. Do you ever get pushback from investors or of banks because of that?
Well, the answer on the bank side is that it was what was offered to us, and
Right.
we really didn't even push back with the lender. The person who was going to bat for us, the loan officer going to bat for us, actually was able to get us 6 years of interest only on that deal and came back with a better interest rate. And he said, if you'd like, I can ask for 7 and really kind of grind them. I'm not a grinder. I'm a relationship guy. So we were able to get the 6 years of interest only in this specific transaction without having to push the lender to, at least as far as I know, to the point where they're not comfortable. In terms of investors, so, I'm a big believer at this point in my life of conservative and also paying things down. But being said, there's always the I guess the angel and the devil on my shoulder. The angel saying amortization is not your enemy, and the devil saying take the interest only, because what's the worst case scenario? You give people a higher yield. And as long as it's low leverage, you're not going to have a problem. So on a deal like this Bremerton deal, in theory, the thesis here is since it's an affordable deal with huge insulation between market rent and affordable rents, and you have a clear window, it's a 15-year give or take time frame until the tax credits burn off. The fact that we're not paying down our loan over 5 or, in his case, 6 years shouldn't impact us negatively at all. I'll give you another deal we did back in, I think, 2012 in Dallas, central Dallas. We bought a 1,032 unit, 4-building contiguous. So it was a single asset, but a single contiguous 4-property structure in central Dallas. We bought it from a REO special servicer. It was a CMBS loan that the prior borrower, who we had known, fell delinquent on. And the reason why, or at least what was explained to us at the time, was it was a 10-year loan. The interest rate, if memory serves me correct, was about 6%. I believe he bought the property probably between a 4 and a 5 cap. So there was that negative convergence at the time, which was the 2006 and 2007 mentality, because CMBS lenders were so aggressive. But the issue where the deal fell off and where it went back to the lender was because the interest only had burned off. It was a 5-year interest only deal. As soon as that interest only burned off and they had to they had to pay down principal, the building was lost to the lender. So unrelated to the Bremerton deal, but more to what we were discussing a moment ago about the fears of interest only timeframes burning off. Not a concern on the Bremerton deal.
Of the different investment strategies, let's say ground up, distressed, value add, stabilized, which ones are you really focusing on? Do you consider the discrepancy between market and the government HUD loans, is that considered a value add strategy, or what's really your focus?
Our focus at the moment, where we are in the cycle, is the affordable housing, low income housing, tax credit, property acquisitions. It's just something we understand very well. It's very complicated, and we've been able to do very well with that in this inflection point of the cycle. I can't wait for distress to come back. There's nothing like buying low. I mean, the whole concept of distress is you're buying a broken asset, and you're getting it for a discount as a result. Of course, there's a tremendous amount of risk in doing so you have to watch your leverage when you do that. We also have developed in the past. We actually just finished our last development project of the cycle. That's in Denver, Colorado. We do think there'll be maybe a small opportunity. I think there'll be a small window of opportunity for development again in a few years, which I'm happy to explain. But we do it all. We buy core stabilized. We buy value add. We just aren't buying core stabilized and value add right now. I don't believe in value add strategies at this point of the cycle.
It's interesting that you are. So help me explain how the development, you would predict that to be in a few years. So you're saying potentially after a correction, there may be time for development. Is that correct?
Yeah, but the time to prepare for it is going to be soon, in my opinion. It may not even need a correction. What you're seeing in development is you're seeing incredibly high labor and commodity costs. So building is very expensive. Land prices are priced to perfection. People are performing in incredibly high rents, high occupancies, and low cap rates. So what's happening is lenders are pulling back. That the lenders in the development space are pulling back. They're making fewer and more conservative loans. Deliveries are occurring right now, and there's a major pipeline of apartment deliveries going to be happening over the next couple of years. And the thesis is that a lot of projects that are in process of getting their entitlements or their packages together. I call it packages. A package could be your entitlements with your blueprints, your plans, everything's ready to go, permits in hand, except the cap stack. So we made quite a few bets in the last cycle where we bought these quote unquote packages, or we assumed these packages back in 2010 and 11 when you couldn't get anything built because the lenders weren't there, the equity wasn't there. So the product being built now, yes, there's a lot of it. It will be absorbed at some point. There'll be another lull, is our thesis. Similar to kind of single family housing. There's very little single family development is at a low right now. At some point, homeowners are going to come back into the market. Homeownership's at a very low a low position right now. I don't know the exact percent, but we hit as high as 70% homeownership in the peak of the last cycle. We're down to somewhere below 63% right now. The point being is that there becomes these windows of opportunity where you can get in and start doing things ahead of everyone else. And in the case of development, it's taking over packages from people that are turnkey, ready to go. And there's a lot of risk there as well, but a lot less risk than taking them over and starting development now. So the thesis being all the deliveries happen, contractors or subcontractors and contractors and building material prices, all the pricing comes down, and that's when you want to lock in your deal.
Are you guys net buyers or net sellers at this point? And how long has that been the case?
Okay, so we're net neutral at the moment, and that hasn't been very long. We were net buyers from 2009 through 2013. I'd say we were net sellers 2014, 15, maybe half of 16, and we've been, I think, net neutral, where we kind of trade in and out of one here, one there. So I'd say we're pretty even at the moment.
And how many properties do you guys currently have operating?
Yeah, depending on how you look at the portfolio, it's always give or take 30 assets that we own and operate that there are projects. We also have an asset management portfolio with another number of assets that are with other partners, and we always have a small building portfolio of buildings that we kind of own ourselves that adds to that. But it's 30 core projects, I'd say, at any given time, give or take.
Wow, that's incredible. So. Okay, great. Well, let's talk about some of the closing questions then. In your career, what is something you wish you had done differently, or something you wish you had learned earlier?
Okay, so, and again, we haven't quite gotten to the point where I'll tell you about how to lose money in this business, or how to take a loss. But the thing I regret most is having sold deals. It's not the bad deals I've done. I can shoulder those. It's the good deals I've sold. And I've had to sell them for a variety of reasons, whether it was I was making my way in the business and I either needed a liquidity event or I needed to show asset sales for track records. But that's my biggest regret. And I'll just illustrate. The first building I ever bought was that 8-unit building in North Hollywood, California. I paid $485,000, give or take, back in 2002. I sold it 1 year and 1 month later for tax reasons to a buyer for $785,000. The IRR was through the roof. It was somewhere in the neighborhood of 70%. I was, championing myself. That same buyer sold that building in December of 2015. Same guy. I just happened to look through the database of records at the time, and he sold it for $1.5 million. My point is that he went through a full cycle. And had I still owned that building, I would have presumably paid it down, paid it off. It would have been continuing to generate cash flow. And instead of having sold it for $785,000 a year later and pay taxes, we would have sold it presumably for $1.5 million, or it would be worth $1.5 million. I think it was 10 years to the day later, or something like that, maybe a little bit more. It was a little longer than 10 years. So my only regrets are the deals that I've sold, and I can give you 30 more, 40 more examples of that. Now, there's always deals I do need to sell because they are maintenance headaches. We call it leakage in our office. You can underwrite a deal perfectly. You think you underwrite it perfect, but you can't underwrite for too many below ground sewer leaks when they happen, or a miss on CapEx. It just leaks. All the money just leaks out the door. So deals like that, we can't wait to get rid of. But it's the newer vintage, the nicer buildings, the ones that generate cash flow, real cash flow, like print money. Those are the ones I regret. And that's my biggest regret in this business.
Interesting. So like you mentioned, a lot of people like to talk about how they made a lot of money in real estate, but give us an example of how you actually lost money in real estate transaction.
I always tell people real estate's pretty much a guaranteed way to get rich slow. If you're methodical and slow and you take your time, you're gonna make money. Unless you make dramatic mistakes. The biggest mistake I've ever made was employing too much leverage at too high of an interest rate on a deal in a marginal market. And I don't care what the market is. It could be the best market in the world. I still wouldn't put too much leverage on it on a deal with too high of an interest rate. I bought a deal. It was an REO. There were two deals I bought, two different REOs, actually three, but I'll illustrate two of them specifically, both in Houston, Texas, both in 1970s construction, and both in very poor markets. One of the deals we bought 50% leveraged. They were both bought from lenders, 50% leveraged and a 5% interest rate. The other deal was bought with 85% leverage and a 13% interest rate, which in hindsight is crazy. Well, I had to feed that other deal $1 million a year plus. It was for a little less than a year in interest payments until I was able to sell it. And ultimately I was able to get out of it, but it was a painful experience. Whereas the other deal I had bought on the other side of town, they both had performed along the same lines. They were both moderate performers at best. We sold both of them for more money than we bought them for. But the other deal, we ended up selling, making money, having a very nice IRR. And the illustration there is don't employ high leverage at a high interest rate, especially when it's in a marginal market at best.
Yeah, I completely agree with that strategy. In fact, almost every single horror story that I've ever heard involving real estate, almost every single one has something to do with the loan. So employing a high interest rate, employing ultra short loan terms, not extending when it's probably conservative to do so, is like the main takeaway that I keep hearing from some of the experts that I've interviewed. So as far as the future, on the bright side of things, what are you looking forward to in 2017 and beyond?
I think the number one thing I'm looking for in 2017 is some clarity. There's a lot of volatility. There's a lot of unknowns and uncertainties in the market. Donald Trump's tax plan, the Republican tax plan, is a big one. It's going to impact, it could have dramatic impacts on how we value real estate. I'm looking for direction on job growth, but really beyond 2017 is what we're looking for. And it's when do we need to be prepared to start yelling from the mountaintops again that it's a buying opportunity? So that's what I look forward to most is when the market collapses, when it softens, and when the buying opportunity starts. I just don't know when it is.
Yeah, I think you and I are both very much looking forward to that. And I think that's a great note to end it on. Jason, I really appreciate you coming on the program. I know you're knowledgeable in multiple different sectors of real estate, so we need to have you on in the future to discuss some other stuff as well.
Be my pleasure.
Awesome. Thanks again.
Thank you.
For all the listeners out there, thanks a lot for joining us again. You can contact Jason directly for any questions you may have at jason@postinvestmentgroup.com. You can also visit the Post Investment Group at www.postinvestmentgroup.com. For those of you that are enjoying these podcasts, make sure to subscribe in iTunes on your iPhones. Go to your iPhone, open up iTunes, search for Cashflow Connections podcast, pull it up, and click subscribe. That way it'll automatically get downloaded directly to your phone. And if you are enjoying the podcast, make sure to rate it with whatever you think is appropriate, aka awesome 5-star rating, so that more people see that we are delivering good content to our listeners. It becomes a lot easier to get quality guests like Jason back on the program. Thanks a lot.